Now, in spite of disappointing numbers today on the retail and jobs front, my next guest sees the possibility for big gains coming next year. That would be 2011. I want to welcome Joseph McAlinden. He is the fund manager for Catalpa Capital. He's also the former chief investment officer of Morgan Stanley Investment Management. Joe, good to have you with us on Bloomberg.
Great to be here. Thank you.
So are you still optimistic in the face of the jobless numbers and also the retail sales report from some retailers?
Yep, today's reports do not make my case, but each day is another day, and the last few days it's been like that. You know, one day you get some good numbers, the next day you get some soft numbers. So in the past week or so, you've actually had some surprisingly buoyant figures in the non-manufacturing ISM numbers. Even in the manufacturing ISM numbers for the U.S., they were off a little bit, but they're still above 50. These are all diffusion indexes, which we watch very carefully.
What does that mean, diffusion index?
What it means is if it's above 50, the economy is expanding. It's only a question of how fast it's expanding. So you've had some kind of coming off of the boil, not that it was boiling, but a little slowing in the economy, but it's still in an expansion mode, which the slowdown in growth expectations, however, has had a silver lining. And the silver lining is that the Fed and China's central bank, certainly Japan, are much, much farther away now from any kind of tightening moves in the U.S.
Meaning they're not going to raise interest rates for the foreseeable future?
Indefinite future. In the U.S., the expectations have been pushed out now to the third and fourth quarter of 2011. And a lot of the commentary you're seeing out of the Fed is that they're more worried about deflation than inflation. And so that is an environment where you generally have pedal to the metal with monetary policy. When you have pedal to the metal on monetary policy, you have rising stock prices.
Well, let's just talk about deflation for a moment. I mean, because in speaking to Gary Shilling of Gary Shilling and Company, the economist, earlier today, he says, yes, we're going to see deflation in the United States, meaning prices are going to fall. And yet, whenever I talk to anyone on an individual basis, they say, you know, the price of everything they buy, whether it be food or gasoline or indeed education or healthcare, it's all going up. How do you square those two comments, deflation and inflation? I guess you could have them at both at the same time.
Well, actually, technically, you can't.
You can't?
I mean, deflation and inflation are terms that apply to the general price level. So if
the consumer price index, for example.
So if the prices of everything in the country are rising, that's inflation. If the prices of everything on average are falling, that's deflation. You always have the prices of some things going down and some things going up. Tech, you could say, has been in a deflationary mode for years. The prices of tech just keep going down.
Like buying a computer, the computing power increases and the price decreases.
Right, but you could hardly say that your experience with health insurance and movie ticket prices has been deflationary, nor is there any sign of deflation on the horizon for those things. And in fact, your loaf of bread, given what's going on, sadly, in Russia, and Europe is going to be a lot more expensive going forward.
Sure, the Russians banning those wheat exports until at least the end of the year because of the severe drought in the country.
That's actually a big development and has a lot of thematic implications for some trades in the U.S., actually.
All right, so if we are going to have, moderate growth, does that mean that stocks are going to do well? What's your call for the second half of the year?
All right, so let's just roll the video back for a second. We had this huge rally off of March 09 lows. Then we made a top. There were a couple of false starts to corrections that never blossomed fully. The correction from the third week of April or so up through the beginning of July was very strong. It was down 16%. We've already made up half of that. And I think we're going to, I think you'll see the chart of the S&P just continue to recapture that decline and probably break into new highs before the end of the year. But the big potential is for next year.
New highs before the end of the year?
Yes, marginal new highs.
Marginal new highs. So we're going to have this back and forth with the economic data. Some of it's going to look good, some of it's going to look poor.
I believe that's going to continue. It's going to be a laborious climb until we get more towards the beginning of next year and get some clarity on tax policy. And on the economy itself. And I think the economy is going to be strong enough to generate continued upside surprises in earnings, which we've been getting. The second quarter numbers were amazing in terms of this ratio of positive to negative surprises. And I think that's going to continue as we move through 2011.